guide us as to what is permanent and what abets consistency. Thank you very much, Mr. Mistry and Amitabh. Well, first, Mr. Mistry, both HDFC and HDFC Bank have been able to give an extraordinarily consistent performance. If you can identify for us what is controllable, because banking is essentially cyclical, NBFC is essentially cyclical. What is controllable, what is not controllable?
I think if you ask me, Lata, there are relatively few things which are uncontrollable. Relatively few things. So sorry, I differ from what you said. What is uncontrollable is interest rates. What is uncontrollable is the economy. What is uncontrollable is currency. But if you run your business well, if you keep the strongest form of risk management practices or you adopt the strongest forms of risk management, you will generally always be consistent in your results. I mean, I remember something like 25 years ago when I first started meeting investors in the 90s, and Amitabh knows we talked about it. All our investors at that, I'm talking of the late 90s, sorry, not early 90s. A lot of our investors were coming and telling us you're losing market share. Because there's this private sector bank which is just coming and, taking market share. And I remember telling all our investors at that time that we are not in a market share game. We have consistently kept for ourselves certain objectives. So what are those objectives? Our objectives is that our return on equity must rise in those days by 100 basis points a year. Our cost-income ratio must be must be single digit and must keep improving year after year. We must target a growth of a certain percentage, which is then a function of how the economy worked. But we would give quality service, we would manage our assets and liabilities, we would not take short-term money at low rates and lend it, for long-term and take a huge maturity mismatch, which would backfire if suddenly interest rates go up. So we had to take in a lot of these kind of checks, put in these kinds of checks and balances in our business. And that brings about consistency.
Well, you will have to admit that perhaps a bit of financial engineering also helped. I mean, it's at least with HDFC Bank, the analyst perception always was that in good years, some of the money was kept aside in provisions or in other areas. And at times, say like 2009 or 2008, in one of those volatile years, or maybe even 2002-03, when we were just turning up, those were also factors.
I don't know about HDFC Bank, but I can tell you one thing.
You do know about HDFC Bank.
But let me tell you generally that today, the accounting standards in India are so sacrosanct. For a bank, there are ways and means in which you can create a buffer, you can create a provisioning. But if you're following INDAS accounting, Indian accounting standards, the new accounting norms, which all NBFCs, housing finance companies do, you cannot do that. If I want to make an excess provision, I have to identify a loan against which I make that excess provision. I cannot just make an ad hoc XYZ amount provision. You can't do it. It's not possible. In the new accounting norms. In the old accounting norms, yes, this was possible. You could create
some elbow room for keeping reserves. Amitabh, actually a similar question to you. In your playing, I mean, you have been a banker and then you had a stint in insurance and with a group that is known for consistency, and then now back to a bank which showed volatility. You stepped in when immediately after the asset quality review, so there were problems. So if you can identify, can you have consistency factors and uncontrollable factors?
So just building on what Keki very articulately put forward, that there are uncontrollable factors, a few of them. I think there are some more. End of the day, the geopolitical situation has had a huge impact across the world. We had this pandemic, which is completely uncontrollable. There are technology risks which are emerging daily, continuously. And you have seen players which you could not imagine 5 years back coming and wanting to play in your space. So there are these uncontrollable factors. But I think, as Keki very correctly pointed out, ultimately, if you have the right leadership, if you have the right principles in place which you consistently follow, if you believe in certain parameters, I think the biggest part of consistency in my mind is defining what you will not do rather than what you will do. I think a lot of people focus a lot on what they will do, but I think they forget to tell the world what they will not do. And because they don't tell them what they will not do, they just keep doing stupid things in the process. So I think once, if you even hear what Keki said, he said we defined our risk framework. We were not in the market. The word was not in the market share game. So I think he defined what they will not do.
Define your don'ts.
I don't. And I think once you do that, you have the right leadership. You're obviously anticipating the uncontrollable factors in the environment and reacting to it. So worse situations will happen. But what you make out of...
Market share at any cost is a don't. What else is a don't?
No, the biggest don't is what is the value system you have, and what value system will you carry through. And I think if you look at HDFC as a group, I think there is a certain value system they've stood for, and I think that has stood them in great. I mean, I've worked with the group, I've learned a lot there, and I think that has worked wonders for them. And I had a opportunity to work at Infosys. I think you've seen similar traits there too. So one is the value system. Second is businesses, you define what you will do, what you not do. Third is that I think you need to know what will differentiate you from the marketplace. If you want to deliver consistent performance and manage these uncontrollable factors, there's something you should be known for, because that will hopefully carry you over the tsunami or tide, whatever comes through. And I think if you have either you're a leader in the market, or you have a certain market share, or you're respected, or you follow certain consistent principles, your performance will come through. You will dip, but you will always be rising above the rest of the players. They will suffer much more than you. And so, based on the definition, what I see of consistent players, you will hopefully stand in good stead. So I think you wants to add.
So the don'ts are, go ahead.
Sorry, can I just add one thing? You asked what is it that you should not do, and to create consistency. You take the example of 2018. ILFS went. You had a period of 4 years where interest rates were extremely low. So you had so many NBFCs, and I'm not naming anyone, but so many NBFCs which went to the market and raised 3-month, 6-month money and used that money to give 3-year, 5-year, 7-year loans. So the yield curve was reasonably flat. You could borrow money at an extremely low rate and lend money at a high rate. And when your liability matured, 3 or 6 or 9 months, whatever it was later, because interest rates continued to remain benign and in fact were going down, you could refinance your liability at an even lower rate and expand your spreads and increase your profitability. But then when the crisis happened in 2018, it caught up with everyone.
No, that's a fair point. Actually, I was going to come to that 2018 point when it almost looked as if the banking sector could yield place to NBFCs. We heard so many speeches to that effect. Ramdev, as the neutral observer, what do you have to add to this in terms of, what did the consistents get right and what did the volatiles get wrong?
Yeah, I think we have a very interesting situation here. I mean, here is the epitome of consistency coming from house of entire group. I mean, HDFC. I think they have an ethos around how to manage the risk and maybe risk arising out of counterparty risk. I mean, whom they do business with, because it's a business of lending. So clearly, that has been the cornerstone of, and I used to, I mean, whenever I met Mr. Parekh, he used to say, learn to say no. So clearly, they have not only said so, they also practice that. So clearly, I mean, HDFC story is very well known. We have read all the balance sheets. But I think the real most interesting thing is Amitabh's situation, where UTI Bank or Axis Bank was one of the fastest growing and most consistent bank between 2000 and 2015. It grew at mind-blowing 38% compounded, year after year. There is no year of break. And then comes 2015, I don't know what happens. Maybe the corporate loan book blows up or something like that. And you have, still, I think this is the first year of consistency, I would say. I think the moment he got into the saddle, COVID happened. But now I think he's got, I mean, now the stock has gone, I think the profits are also, it's the very first year. So a lot is to be said. I mean, it is clearly visible in the graphs, I mean, what has happened in Axis Bank. I think Amitabh can throw some light. Maybe he was not there in those 15 years, but he would know what really happened in those 15 years and what went wrong in next 5 years and what is going to go right. I mean, are we seeing emergence of one of the, because he has been trained to be consistent bank. So what is the challenge of making this volatile bank into a consistent bank?
What HDFC elements are you bringing into Axis?
Thank God I'm sitting and talking here when at least the last bar is there. Otherwise, I don't know what would I have said. Now I can give some speech, maybe not like Keki, but at least some speech. Obviously, what happened after 2016 was we paid for some of the mistakes we had committed in the last 5 years. So we paid for not only the principal which never came back, but we also paid for the interest which we recognized as income. And, kind of that also we had to recognize as losses during that, volatile period. COVID did not help. So there are 2 years of COVID in it. I think, but it also gave us an opportunity to set some things right. I mean, we had launched what we call the GPS strategy, but S stood for sustainability, which is all about sustaining consistent performance. And sustainability had some very simple elements to it. Becoming more conservative, moving towards process excellence, improving your execution, more pristine quality in terms of assets, more ensuring that the risk guardrails are tight and they cannot be interfered with, ensuring that the credit and business are separate. In our case, they were within the same department, so the business could decide whom the money had to be given to. So we did a lot of those things, and the problem with sustainability is it takes time to come through. I'm not saying the journey is over. I think it's still a journey we are on. I think the system will test you because people who worked in a certain environment for the longest period of time will come and test the door, whether it can open a little bit like it used to open in the past. And you have to be very, very firm. So this will take a little bit of time, but yes, our graph does show that we have reached a level of granularity in our business. Earlier it was performing for the next quarter. Now we have started thinking how it will look like for next year because we know what the next quarter will look like. So our prediction and our projection on what we can do has improved dramatically. And slowly, gradually, I think we should be able to lock in a year at a time as we move forward, in spite of whatever we might see in the external environment. Obviously, external environment can come and change things a little bit, but broadly, where you'll end up. And frankly, for me, if a business cannot project what they will do in the next 12 months based on what they see today, I think sometimes they, in a way, don't know. And I've learned this when I used to run a BPO company. In a process, forget about a company, in a process, if you really measure the process well, you should be able to define upfront what is the quality I will deliver month on month for the next at least 3 to 6 months, if you know what you're doing. So I've just, picked that up from there and build on it, and the same thing can be applied to a business. So you need the right process in place, and I think that's what SGFC Group has done consistently. In SGFC, Limited itself, and then obviously a lot of other companies in the group. All of them have consistently shown performance. And we are trying to do exactly the same thing in Axis Bank. Please understand that when you go through a transformation like this, there is a lot of short-term pain. Because if you start taking decisions for the long term, there is short-term pain. Because you're trying to remove some of the problems which exist. And you cannot keep talking about the short-term pain all the time, because then, people say that's all you have. Your story only is to blame the past. So you have to just take it, absorb it, and keep moving. And hopefully the numbers will show. So we have, as you said, we are just getting there. A long way to go. I mean, we have a track record of SGFC which goes on for decades. We have, we're talking about 1 quarter and trying to build a line here. So we have a long way to go. But I think we have put the granularity in place. And that is a combination of so many things you have to do. It's not just one thing.
Basically become an SOP bank.
You have to be. Otherwise, ultimately, as end of the day, the banking business is very complicated, but it's very simple also. You just have to do some of the things right. You need, in P&L is only 4 big items, end of the day. There is rent interest income, there is fee, there is, your cost of doing business, and credit cost. I mean, I know I'm making it very simple, but you need to manage 4 items in P&L. You just need to focus on how will you manage them, what are the principles you'll use to manage them, and I think once you get them right, things do fall in line. And I'm sure Keki can write a book on this, but I'm just making it very simple. So he's the god here.
At the moment, it looks very attractive to actually buy public sector banks, because it looks like some process of, correct management principles have been learnt in the public sector bank, and certain institutions have come, like CRILIC. I mean, probably if CRILIC existed earlier, the banking sector may not have gone through that kind of an asset quality review. So, I mean, how do you explain that? Is it possible that not just a company, but a sector can go from volatile to consistency for a period of time?
Of course. I think that's why we are saying that financial sector can go, the credit cycle could last for, you would be better judged to say how long this credit cycle will last. But if it lasts for 7-8 years, after that, a decade-long washout, if the country gets consistency, credit cycle gets consistency, both are interchangeable. If that happens, then all the companies, all the public sector banks, they were beaten out of shape. Half book, 0.4 book, 0.3 book. So one is that you have the investor psychology which has completely hated these companies, and you might have seen the presentation. All the PSUs, forget about PSU banks. I mean, there is a zero wealth creators. In 2004-5, 40% of the wealth was created from them. Not a single PSU has stood up to become a wealth creator. So clearly, it is a complete reaction, and everything is not justified. Every private sector company is not as well run as all the public sector companies. So I think there is a hope at this point of time, particularly public sector banks, that the reversion to mean will happen in terms of at least multiples, the price to book.
How do you pick within that public sector bank? Do you look at management quality, CEO quality? How do you
Yeah, there also,
distinguish?
given the restrictions or the challenges of working within public sector in HR policy, compensation policy, promotion policy, what they can do, what they cannot do, how much social sector they have to do. So those things, keeping that in mind, again you have maverick leaders who are they come for 3-5 years, but they do make a difference. So if you have this kind of environment where you get very energetic and very good banker to lead a public sector bank, I would say that those are the banks which could see much high, because see, private sector is trading at around 3 book. Public sector is trading at
0.3.
Not 0.3, now say 0.8 or less than 1 book. So clearly there is a scope, and particularly when the consistency, see, wealth is created during consistent period. And I think the backdrop is for consistent performance of averagely run banks and NBFCs. So as the consistency continues, I think people are going to move from a consistent old like private sector banks where they gave fancy valuation. They would say, okay, here is consistency, let me put some money from there to here. And that's why leader of the pack is SBI, which traded at 0.5 book in 20. I mean, at 150, 160, it was a half book. Now, book will go at 15%, and if price to book goes from half to 2.5 at the peak, you are looking at 7 to 8 beggar from the bottom. So it has already done 4x. Maybe another 3-4x is still in store if credit cycle works. But that doesn't take away what can happen in the private, because these banks, they are super banks, like all these private sector banks. They have a huge incentive structure at the leadership level and highly competent this thing. And the most differentiating factor I see is the technology. And technology is a very consolidating factor. It's not very democratic. 20 licenses doesn't mean 20 players. One bank can be 20% market share. I think that's where I think likes of Amitabh, who have little technology background also, have chance to create a bank of disproportionate size in next 10 years. And, one of the things which was coming to my mind is that the first debacle in Axis happened because of corporate loan book. Now, seeing that, all the banks are saying we want to build a consumer book. My sense is next blow up is going to happen in consumer book. Because corporate book will be, there is IBC code, and borrowers will be cautious, and lenders will also be double cautious. So what will happen is maybe I'm not saying that Axis will do that, but the caution might be required in building up unrelented consumer book. Do you think anything like this can happen for the system per se?
See, if you look at all the commentary on the retail side of the balance sheet, I think that commentary or that fear and worry has been there for quite some time that the retail book could go south for the banks. This was been said pre-COVID also. The cycle has gone on too long. One day it will break. My view is that, please let's understand, there is a risk-reward curve and a risk-return curve where the banks, even let's say HDFC and some of the bigger banks, are playing on the lower end of the risk curve. They're not, lending to anyone out there. There is a long tail of NBFCs. There is a long tail of public sector banks who are getting into this higher end of the risk curve in my mind. So one is that, firstly, we are playing on the lower end. Secondly, I think as information flow has improved in the system, and if you can, from using technology, using AI, using analytics, can absorb that information which is coming to you, your ability to underwrite, frankly, every Indian is improving. Forget about the right kind of customers. They are overbanked. But your ability to underwrite every Indian is improving dramatically. You look at account aggregator platform, now GSTN has also been added to that platform. So as more and more information becomes available, and as you move with that information, you create the ability to absorb the information, understand it, and being able to underwrite the customers based on that. I don't think if the banks get it right, they will lose money. I don't think so. Yes, in a cycle you could lose a little bit more, but all of us have now such sharp and such well-defined policies on provisioning that if there is a slight deterioration, the self-correction mechanism also kicks in very, very quickly. So, I'm not saying that the losses could not go up, but if they go up, they will go up marginally only. You will not see a bloodbath in terms comparison to what you saw on the wholesale side where large amounts went down. So I would say that the larger banks, larger institutions are better protected. The information flow will help. They are at the lower end of the risk curve. But yes, if someone for growth purposes starts going a bit berserk, things can go wrong. But
can technology take away the game? See, that's what Deputy Governor Ravi Shankar actually chided the banks the other day at the IBA, saying, UPI came to all of you. Why didn't you all create the Google Pay?
we did not have 3,000 crores of money to, make a loss on. Mr. Ramdev Agarwal would have killed us by then if we had spent 3,000 crores in just creating a market share in UPI.
Banks together
That's reality, Lata. That's reality.
Banks together could have done it.
If you had formed a subsidiary where Mr. Ramdev Agarwal would have taken equity and allowed us to spend 3,000 crores, we would have spent and taken that market share. Today, that's a problem with technology, that if there are companies who are being funded through capital, who can then spend that money to acquire customers and make huge losses and get more value in the process, banks or the institutions which have been around forever cannot afford to play that game. So we have to play the game slowly, build brick by brick, and hope that our technology will catch up. One. Secondly, we hope that these valuations will go away, which has happened. And hopefully in the future, this capital will not flow the way it has flown in the past. Now, unless these players, which are being talked about by the Deputy Governor, very rightly so, they do some other business. This business makes no money for them. So they have to do something else. So what are they doing? They're talking about NBFC license. Moment they talk about NBFC license, RBI said, okay, I'll govern you. They don't want to do that.
RBI is batting for yours.
So yeah, no, but RBI is saying come through the front door. If you want NBFC license, come through the front door. So my view is that end of the day, yes, they have gained market share, and yes, the banks have been slightly behind. But if they want to make money, as I think you have said, Mr. Agarwal, so many times, that ultimately cash flows need to show up. Ultimately, that's how the valuation will be based. So I want to see where the cash flows are. We are working with these very entities, and I think they are playing two games. One is that they are trying to ensure that they become a distribution channel and they collect a toll on the way, or they will themselves become competition for banks. And competition is welcome, no problem.
Well, actually, I was going to come to the technology as a theme a little later, because I wanted to get from Mr. Mistry about the merger. I mean, that's a large bank now. 18 lakh, 19 lakh crore. Is this consistency possible?
If you ask me honestly, and I genuinely mean it, I think the growth can only accelerate. Because from the bank's side, let's assume that the bank's balance sheet is whatever, 13 lakh crores. That 13 lakh crores has been growing at 18 to 20% a year and can consistently keep growing at 18 to 20% a year. Then you look at HDFC. Our balance sheet, individual loans is say 5.5, 6 lakh crores. In the last quarter, we grew at 20%. And if you look at a CAGR over the last 5 years or so, it's about 17 to 18% in terms of loan book growth, individual loan book growth. Profits may be higher. So that 17, 18% growth was coming about without using the distribution machinery of the bank. The bank has something like 7 crore customers, 70 million customers, 2% only of these people have taken housing loans from HDFC. So look at the ability to cross-sell to a larger group. The bank has close to 7,000 branches.
You all could have cross-sold even before, no? After all, you're all in the family.
In a way, we as HDFC Limited did not want the share of loans brought by the bank to be more than a certain percentage of our total business, because at the end of the day, we have to have our own distribution platform. Secondly, the bank has something like 7,000 branches, but distribution of housing loans all this while has happened from probably less than 2,000 branches. So it's a huge, huge market. So in my view, assuming that the feel-good factor in the economy will continue, which I honestly, truly believe will continue, I would think the growth can only accelerate. Does that make it consistent?
Yeah, Kiki, if you look at the data, HDFC Limited has grown at 20% compounded, which is for last 22 years. And stock has also given 20%. So G is equal to R. So that's been the formula. And from here onwards, the credit cycle itself is like 15-70%. I would think that for such a competent underwriter, for them to go 2, 3, 4% higher than system growth should not be a big challenge. I would agree with you. But I think the real thing is, I think that we all can see from outside. The issue is that, do you think the new management, very sudden types, like the kind of a management team which has come up, yes, of course, the HDFC Bank, and then on top of it, this merger. So do you think it will be, because 20% on 18 lakh crores is like 2-3 lakh crores, almost a second, third largest bank being created every year. So, I mean, what you all have done in last 25 years itself is unbelievable. But I think what will happen in next 4-5 years of creating 3-4 lakh crores of balance sheet with impeccable underwriting capability, that would be even bigger thing which will be achieved in next 4-5 years.
When SBI was 20 lakh crore, they were growing at single digits, 10%. When SBI was 20 lakh crore, which was not very long ago, before the 5 banks merger, they were 20 lakh crore in 2017?
I mean,
they could manage only single digits.
Let's forget about comparisons. Comparisons are not relevant. I think what is relevant is that, as I said, the people you are talking of in the bank are the same people who've been there for the last, 25 years. It's not that it's a new bunch of people who come in. So the ethos, the culture, all of that is already set in. Growth opportunity, I personally feel very strongly can be much, much higher. How does it matter whether it's 20 lakhs or it's 30 lakhs or it's 40 lakhs? Your distribution is there. Your distribution platform is there. The distribution has not been used to the extent to which, it has potential to be used. If you look at our own customers, 70% of our customers do not bank with HDFC Bank. A lot of them are happy customers, people who've taken a loan from us, people who have a sense of well-being towards us. If we go back to all these people and say, look, we are one entity, why don't you shift your savings, current, etc., accounts with HDFC? I think we'll meet with a lot of success. So there is a massive cross-sell opportunity which opens up.
Yeah, maybe globally all the large banks are not person-dependent. But here, I think in India, because the managements have stayed in the saddle for a very long time, so there is some kind of anchoring around a name. So, do you think we'll be able to get over, this particular kind of phobia, or because there's a change of name, change of leadership, and that too after 40 years. You have been there for 40 years. Now the entire guard is changing across the board. Every bank here. So, what do you think? How do you see sitting outside? How this journey will happen?
So, Ramdev, people are the same. You may have one individual, 2 individuals, 3 individuals who will not have an executive role in the merged entity. But that is because of factors which are beyond anyone's control, age limits, RBI limits, so on and so forth. But the people down the line, the people who are generating the business, the people who are doing the business, it's not that as CEO, I or Renu or any of my colleagues at the senior most level are looking at individual loan appraisals or corporate loan appraisals. We are not. It's just an automatic machinery which you have to put in place. Once you put it in place, it just keeps growing by itself. You have to ensure that people are there. You have to ensure that that the turnover of people is very low. Our attrition rates in HDFC is about 4% a year. So the same people have been around for years and years and years, who will continue to be there.
Amitabh, what is your best guess of how long this good cycle can last? Once again, I think I asked you this question even earlier. The bottom, when I started covering banks, was 1999, 2000. Went through very bad times. And, once all that correction happened, we had a clean 10-year run. Now what? We should consider the bottom as 17, 18 perhaps. Is this a 10-year run?
Well, I do believe that the cycles are shorter than before now, because I think the world has become a more unpredictable and volatile place. So to assume that we can have a 10-year run, well, it does happen. I hope it happens, but I think in our minds we should be prepared that maybe the cycle will not last that long, because there are too many fools around in the globe who can do stupid things, and we have seen that, examples of that. The second thing is that, yes, obviously we're in a unique situation. India is uniquely placed. And all the parameters, as Ramdev pointed out, are all pointing to the fact that we are in a long-term credit cycle. And obviously, different banks are positioned differently to capitalize on that opportunity. We are hopefully going to see a GDP growth rate in India, given where its positioning is and what it is doing and what the government policies are and stability around that this should continue. But my biggest worry is the risk around global factors. And global factors playing out in some ways which we can't imagine today. And the world is so connected now that for us to believe that we are isolated also is not possible. So, and we have seen in the last 3-4 years how it has played out. COVID, then Russia, Ukraine, then what has happened with China's reaction to COVID, then some of these things which keep happening all the time. A fact that a Korean insurer decided not to call on its, what they call the perpetual bond suddenly led to the, spreads blowing out. It was not because something happened here. It's something happened to the private Korean insurer. So imagine a private Korean insurer could blow out your spreads by 3 to 4% overnight. So that's what I mean by these global factors. And I think we have to be prepared for it. And the companies and the institutions who prepare for this volatility, I think it's not that this volatility will remain forever, but if you're prepared for it, you will actually get an opportunity to capitalize on it and move forward. Because you react much better to any problem which comes your way. Others are, scrambling. And I think in this volatile environment, where it might not last that long, I think the companies who prepare for it well, frankly, can become even more consistent because they do some of these things better.
Ramdev, is too much of good news a bad thing? I'll tell you, this tectonic shift in favor of India, I've heard this before in 2005. So sometimes it scares me. But do you think now we have a secular run, or we should be afraid of, good interpretations?
Yeah, I'm seeing only data, and a lot of participation from retail and all, what we do. But actual businesses, the companies, businesses, they are coming to them. And particularly Amitabh, and and here the real estate, that's after 10, 12 years, the cycle is good. And it has the power to, I would say, one of the thought process was that, can the reality, which was in fire in 2004, 5, 6, 7, and then completely out of shape, and literally the biggest of them were in bankruptcy. Do you think we are into golden era of realty companies doing, because the opportunity size is very large, and they have learned their lessons. But it's still same guys. Sab, kya bolu? So do you think these guys can be seriously large corporates doing 20, 30,000 crore sales, 50,000 crore sales, and profits of 8, 10,000 crores? Can we see those kind of things emerging out of...
I'll come to that, but just take off to add to what Amitabh said on the growth part for India. I honestly believe that the growth for India is there for a very long time. Now, whether it is 5 years, 10 years, it's very difficult to say. There are factors which we need to consider, oil prices, geopolitical issues and stuff like that. But India is so much more insulated from what happens to the rest of the world compared to China or compared to most of the other countries, because we are self-sufficient. So long as we can create jobs for our people as they pass out from business schools, there will be growth. And the penetration levels of if you're talking of financial services, is extraordinarily low. One of the lowest of any country in the world. If you look at mortgages, mortgage is 11% of GDP. If you look at credit card penetration, one of the lowest in the world. Similar car loan, retail credit, consumer credit, you name it. So the growth is there for very, very long. Now, you're talking of builders, right? All right, so if you look at the real estate sector, again, the penetration level is extremely low. I think the first thing you need to understand is that India has a young population. 2/3 of our population is below 35 years of age. The average age of a first-time home buyer in India is about 37 or 38 years. It's not a 20-year-old fellow like in the US who's buying a house. It's someone who's 37, 38 years. And 2/3 of our population today, therefore, have not even reached a stage where they will want to buy a house. So the growth path ahead of everyone is huge, enormous. Now, without getting into specifics of developers, I think the demand for housing will continue unabated for very, very long.
But that was there between 2010 and 2020 also. And we saw the biggest disaster. So I'm not talking about the demand side.
No,
I'm saying that execution. Do you think it will be a consistent period of profit making for this sector?
So I think what happened, Ramdev, is that between 2016 and 2018, there were several changes that happened which refined, which modified, which sort of made the real estate sector more transparent. What were those changes? First, you had the elimination of black money, the demonetization, which took out a little bit of the demand. Then came the Real Estate Regulatory Act, which brought in so much of transparency in real estate deals. Then you brought in the GST on under construction properties. Now builders have got adjusted to that. So many factors happen which were not prevalent prior to 2016 or 17, which took builders by surprise, and therefore you saw the stress in the real estate sector in the metros. But now there is much more transparency. Now people are used to GST. They factor in a higher amount of equity. People are not going on a land buying spree. You're not seeing developers going on a land buying spree. People are watching their balance sheets. People are not letting the leverage go too high. So,
Okay. Well, I'm assuming the question I'm going to ask Ramdev will interest you all. It's not to do with finance. It's to do with his theory of consistence and volatiles. You know, volatiles have made a lot of money. Like last year, steel. If you jumped in at the right time and jumped out at the right time, you would have made much more money than in the consistents, right? Likewise, now public sector banks, it looks like that. You got in at the right time and get out before it's too euphoric. There's money. How do you identify the in and out points?
In volatiles?
In volatiles.
Yeah, so in volatiles, when the first thing is you have to look at the larger companies so that, I mean, even if it doesn't work, you don't die. I mean, these companies don't go out of scene, like a Tata Steel or a SBI. I mean, they are inevitables, whether they are volatile or consistent. So they will be there. There is tomorrow for them.
Capital is not wiped out.
Yeah, so what happens is, when there is a bad time, the psychological pressure on the investor is to dump and don't go near that. And that despair mode breaks down the valuations below values. And that gives the opportunity. But at that is not my type of investing. I was always teji mein teji, mandi mein mandi. That was my thing before this study which I have done right now. But the way to really play smartly the volatiles is to buy when things are broken, and all the sell side guys, there will be one or two guys who will definitely come out and say, sir, now tide is turning. And
So now oil companies are in that position, you
I
think?
think the completely despair valuation is in oil sector, where 6 lakh crores, 5 lakh crores, 6 lakh crore companies, consumer companies, they are all consumer companies. They are available at like 0.1 time sales, like 30,000 crores, 25,000 crores, and they have assets in square kilometers. And I mean, they are the backbone of the economy, and they are free pricing, mind you. Government has not allowed them free prices now, in the sense that they've used their P&L, but
For the fisc.
yeah, but they are also not going to reduce the oil prices.
Don't want to kill the golden goose.
Yeah, so they are going to make up. Yeah, so when the profits come back, there will be a lot more hope, and I hope they don't again make this particular companies more volatile. Okay. So there is an see, if you buy at 0.1 time sales, you can't lose.
You can't go wrong.
You can't lose, but you could be in trap for some time. So that's the thing.
Now,
And in 1 year's time, you could be sitting on two bagger or three baggers. So you have to play the game. Like, see, one sector is the oil companies, but that is public sector. But digital companies,
I was just coming to that.
Yeah.
Would you buy the e-commerce companies?
Yeah, I mean, 1 year
we've
back-
seen them go, the Nykaa, Zomato's, PB Fintechs, all of them come down to what, 1/3 the listing price?
yeah.
In some
So now the despair phase has started. Is it done? I don't know. I mean, because what happens in US happens here. So if the US markets have bottomed out, like Zoom has come down from 220 billion to 20 billion, and now nobody wants to talk about Zoom. Actually, their profits and everything are better. So what I would say, I think the ultimate disasters, despaired valuation is going to come from, apart from HPBP, IOC, I think digital sector. And where digital companies might be available as better values than value companies, like 1 time book, 2 times book. Nobody is looking at their book values. Okay, they are making losses. So I think there is an opportunity to study. I'm not saying go and jump, but clearly digital companies are going to become very big. Some of them who are successful, some of them will become like Amazons of India. So you have to now start studying. And at some point of time, you can start buying little, and then the better days will come.
Okay. A final question to get the banks also in. When will you think we will reach euphoria stage in public sector banks? I'll tell you what, about 6 months back, every brokerage had SBI in their buy list. Of course, you had HDFC Bank, all the private sector, the top 4 private sector banks, and you had SBI. Then BOB. And in the last 1 week, BOI has come into the fray. So when will it be euphoria?
You're asking me?
I'm asking, would ask all the three.
No, they are the more intelligent
Okay,
guys.
all right.
So they know the credit cycle, they
Are we
know.
anywhere close to euphoria with respect to our approach to public sector banks?
Lata, RBI does not allow us to invest in any stock. I don't look at what the stock prices are, including mine, because it's a waste of time. But I don't know about the euphoria. I think the question we have to ask ourselves is, what has really changed in how these public sector banks are being managed? I understand the credit cycle. And are we going to make the same mistakes? Doesn't matter. Earlier we made mistakes in wholesale. Will the system allow us to make mistakes on the retail side now going forward, as you pointed out? And ultimately, what value they can derive in terms of margins and their costs, and what flexibility they have to do something different in the system. As Ramdev pointed out, they were really undervalued, and I think you have seen some valuation going up. At what point it happens, I don't know. I think it depends on the credit cycle. If the credit cycle continues to last for, let's say, the next 5 to 8 years, I think it could continue. If there is a shock, whatever that shock is, I don't know, then I think it could, they will be the ones who will get hit the most very quickly, because they will find it difficult to absorb the shock. Because let's also not underestimate the fact that from a capital ratios perspective, they are still low. They're not, they're not as high as you would like to see, or what a lot of other private sector banks have. So they will get a shock, and at that time they will have to really absorb that hit in the balance sheet, and they do not have that much of absorption capacity. So growth, etc., would have to come down. So I'm giving a balanced answer. I don't know, because I'm not a stock picker. I think Ramdev can do a much better job. But
Mr. Mistry, you want to take a jab at that? Public sector banks, are we reaching?
Without getting into specific public sector or private sector, what I can say is that for the banking sector as a whole, over the last 8 years, there has been a tremendous amount of reforms that have come in. If you look at the banking sector in early 2010, 11, 12, riddled with non-performing loans, undisclosed non-performing loans, low capital, and huge problems. Then came this whole process of cleaning up 2014, 15, 16, 17. And to my mind, and during COVID, a lot of banks have gone and recapitalized themselves. So today, the banking sector as a whole, forget public, private, all of them, stands very, very strong.
Yeah.
Yes.
I would only urge that, yes, I think there is a lot more to go in public sector banks. And so you're going to make tons of money. You'll not believe how much money you made. The issue is, it remains a volatile entity.
Sector.
So when you make a lot of money, leave a lot on the table and run. Don't forget, don't become buy and hold, because they will remain volatile. That's my message.
Okay. Well, I think this has been an extremely enlightening session that we've had with Amitabh, Mr. Mistry, and Ramdev. Thank you very much.